Joining us now in the studio is Khiem Do. He's head of Asian multi-asset strategy at Baring Asset Management. Khiem, thanks for coming in. Well, what's your take on China?
We think that China is going to soft land. We think that
It's not on a treadmill to hell or anything like that, like Jim Chanos used to say. He's changed his mind.
I think that's a very emotive word to use, and
certainly got the headlines, didn't he?
Yes, and I think that if you seriously look at what the balance sheet of China is composed of, I think that that is a statement which needs to be verified.
Okay, so in what way are you advising your clients, etc., to invest that?
Well, for our clients' portfolio over the past 2 months, we actually, if anything, have been adding to China from an underweight position. And the reason why we did that was that because the valuations were very cheap. And we did not believe in the hard landing story, which a number of bears were advocating. So we've been buying banks, we've been buying a lot of property developers, which you just referred to in the previous segment. Because they were trading at something like 50 to 60% discount to NAV. And the property market in China is still quite a young market. It only lasts for about 20 years. So it's not like it is in a massive kind of boom-bust scenario. And so I think that a number of Western observers may get the whole picture wrong. Okay,
Khiem, when we look at the headwinds facing the Chinese economy right now, okay, I've got some of them here, and the risks seem to have actually diminished somewhat because you were a possible blow-up in the banking system in Europe. That's looking less likely given these long-term refinancing options. US GDP, well, it seems to not be a temporary relief. It seems to have got some legs now. And also monetary policy being kept tight for too long. China's already loosening. So those risks have dissipated.
Correct.
But the one which hasn't is the oil price.
Yes, the oil price is a bit of a concern, but I do think that there has been massive focus on the oil price, and I think the long positions on the oil price futures has been rising quite massively. So I just wonder whether there is a little bit of too much, maybe speculative money being invested in in that particular commodity. So I do think that perhaps it has gone beyond the realms of the fundamental valuation of oil. So who knows? It might peak at about 110, but might come all the way back down, below 100 in a few weeks' time. Who knows?
Well, I mean, a lot depends on the unknown that is, of course.
Yes, of course. But a lot of that is priced in. A lot of that
you think so?
A lot of that is being.
I think it's priced into the oil price, perhaps some of it. But what about equity markets? Are they pricing it in yet?
I think that the equity markets, I mean, we did see oil price at 115 just about 12 months ago. So I think that as long as we don't cross 125 on the way up and stay up, then I think we're fine. But if we actually get to 150 and, the oil price stays at those levels, then I think that we have to rethink the whole kind of, benign scenario which we are living in right now.
Okay, I mean, are we going to get 10 straight weeks of rising equities here in Asia? That's the thing at the moment. I mean, we are at the moment getting that.
It's
but
beautiful. It's beautiful, Richard.
Unless you're short, of course.
Yeah,
in which case,
yes.
It's not so nice. I wanted just to get your views to, how do we have a gut check at this point? Because, I mean, we've gone up so far, so fast that we'll have a little bit of a pullback in the next few weeks, do you think?
I think that a pullback, a lot of people who missed out on the rally are looking for it. Because if you put the charts of, let's say, 2010 against 2012, you get pretty much the same picture. You have a nice bounce, and then in 2010, you had a 4 to 6% correction. And so that's what most punters are hoping to see. But, the correction is very mild because I think that there's so much liquidity being pushed into the system. BOJ, ECB, US, Swiss banks, even China with the cut in the RRR ratio. That is some kind of QE, a little bit of QE there as well. So there's a lot of liquidity in the system. And valuations are not that expensive. You
grew up in Australia. Now tell me about this. It's quite amazing, this developing drama. It's not really being played out on equity markets or indeed even the currencies. Why?
Well, this is some kind of, saga within the same party. It's not like we're going to see a change of government. And so, this is a bit of fun for the tabloids. But I don't think that it will impact on the direction of the Australian economy that much. The Australian economy still relies on the growth of China, India, and the rest of the world. And also it relies on the differential in interest rates between what they offer in Australia and the rest of the world. At the moment, the Aussie dollar is good because the Aussie interest rate is high. So I think that the global forces are still much more important than the celebrity big brother. That's what I think that the current PM calls it. I think that's exactly what it is. Yeah.
Thank you so much, Khiem Do from Baring Asset Management.